A ton of Fed speak this hour. Live from New York City this morning. Good morning, good morning. We'll bring you those comments from the likes of Williams in the next 15 minutes in just a moment. Equity futures down 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, Fed Chair Jay Powell sticking to script, President Biden taunting China's leader, and eBay and Zoom, the latest to cut jobs. We begin with the big issue. It's all about the data.
Look at all of the data. The data we saw Friday.
The extremely strong data.
The data right now, the services data. Chair Powell essentially is telling us they're data dependent.
That's the data dependent Fed.
They're figuring it out as they go along.
How largely stuck to the communication of last week's post-meeting press conference.
He basically said, all right, you guys want to play data dependent? We'll play data dependent.
Now he can let the data guide them.
We have a big CPI report coming up next week.
That CPI print is kind of a sneaky risk event.
We need to keep a close eye.
Chair Powell trying not to change too rapidly as the data come in.
The Fed is not going to be beholden to any one data point.
And then you have the market, which of course is going to change very rapidly.
Let's get right to it with our panel. Evercore's Julian Emanuel, Invesco's Rob Waldner, and gents, I want to start with this quote from Mike Gapin over at Bank of America. Volcker has left the building. The Fed is embracing painless disinflation and hopes it continues. We're not in Wyoming anymore. Rob, what do you make of that?
Well, I think, Jonathan, it's quite interesting because he embraced disinflation during his speech, and I think you played a couple of pieces about how data dependence is there. So what they're doing is they're looking at recent core. I think recent core CPI has been relatively tame month on month over the last several months. But I think he highlighted that this disinflation process is going to be slow and I think a bit bumpy. So I think we're in a little bit of a period here where we got some really good inflation news. We think overall we will get disinflation this year, but we could get some more bumpy inflation news over the next several months. So it's not clean sailing for the markets. You know, if we get worse inflation news, the Fed will be back and we'll get nervous, I think. That's certainly what I heard from him.
There has been a change, though. Julian, I think you'll appreciate this. For much of the last 12 months, we had what many people thought was a Fed call. Has that Fed call gone now?
It really has, or it's softening at the very least. But look, it all goes back to Friday. I would suggest that Chair Powell was as surprised as anyone at the extraordinary strength of that NFP number, and surprised as anyone that the labor market has remained as resilient as it has. And frankly, what it all adds up to is sort of a path where, if you think about it in the context of Ed Hyman, Ed is as convinced that the economy is as strong now as he is as convinced that a recession is on the horizon late this year or early next. And if you're not confused, you're probably not paying attention.
Well, Julian, let's talk about it then. Is there a window, an investable window, between that strength now and that recession you ultimately expect? Is there something to get long in between? And how big is that window?
So for us, this is a process, okay? We expect 2023 to be a year of volatility. It's already proven that to be the case, despite what the VIX is saying. If you look at individual stocks, stocks down 70% over the past year, up 90% or more in a month. That's volatility right there. And for us, it's really discipline and sticking to a stock picking mentality, staying close to your home and close to what you know, with one eye towards risk management, which means eventual managing the downside, which we do think is still part of the unwritten story for 2023 before the new bull cycle begins.
And potentially managing a recession, a hard landing, a soft landing. Torsten Slok over at Apollo has really pushed this idea that maybe we have to think about a no landing scenario. He wrote this morning. From hard landing to no landing, investors have been underperforming their benchmarks because they entered 2023 underweight equities, expecting a slowdown that still hasn't happened. Rob, when's that slowdown happening?
So we think it's better chances than not, Jonathan, that we don't actually get a recession. We get subpar growth. And I think that's what we've been having for a while here. We've had sort of potential or slightly below potential growth. We think we'll get that in 2023. But the labor market continues to show incredible strength. The details of that labor market report were strong. And at the same time, wages are not showing signs of spiraling upward. So you don't get the Fed panic. So, we think it's an environment where for the year as a whole, it's probably pretty friendly for public markets, public fixed income in general. But we'll be range trading for a while. It's going to be a little bit messy as we get, as I said, noise around inflation.
So, Rob, if that's the case, do you like Treasuries at 4.45 on a 2-year, 3.66 on a 10-year? Does that all add up?
I think, Jonathan, over the balance of the year, it does. We would be looking for this 10-year right now to be in a range of 3.5% to 4%, something like that. So, you're kind of in the middle of the range. But over the year as a whole, we expect inflation to end the year much lower than where it is now. And we expect the Fed probably to be moving towards cutting rates. And so, fixed income overall offers quite a lot of value on the year as a whole. But of course, we started off, it's a real boom this year, Jonathan. I mean, we're up over 3%. We were up over 3% in fixed income.
Yeah.
So we could get a bit of a range condition for.
Well, Rob, I was going to say to you, I'm not sure that statement carries the same weight as it did maybe 6 weeks ago. How much value is there in places like high yield, triple Cs, after the rally, the spread tightening we've seen in the last few months?
Well, I think Torsten Slok talked about people being underweight equities. I think investors came into the year underweight all risk assets. So we've seen a real, I think, has signs of a position-driven rally. So we've seen probably spreads come in tighter than where they should be. So that comes back to where we would kind of want to enter into. So that comes back to my statement. It's probably a little bit rangy. And when we get a couple of negative inflation prints, which we're likely to get over the next couple of months, you probably get a great opportunity to reload if you didn't, get loaded up at the end of the year.
CPI on February 14th, next week. Look out for that. Yields come in just a little bit today. Equity futures are down 0.5%. We need to talk about corporate layoffs again. The latest, eBay and Zoom. Zoom cutting its headcount by 15% after tripling it in just 2 years. The CEO said this: our trajectory was forever changed during the pandemic. We didn't take enough time to thoroughly analyze our teams and see if we were growing sustainably. Katie Lyons, how many times have we heard different versions of that?
It's eerie how often these messages sound exactly the same. The central thesis of all of them being we grew too quickly and now we have to adapt. And that is definitely what the Zoom CEO was alluding to there. You mentioned how they tripled their headcount over the last 3 years. In January 2020, they had 2,500 employees. By October of last year, that number was more like 8,400. That is how quickly they grew. Now they have to adjust. And it's a similar story for eBay as well. Seeing sales slow down now that the pandemic boom is over, which is why they are also cutting about 4% of their workforce, or 500 employees. Interesting to not see a positive stock reaction for either of those companies today to this news. But I would say the CEO of eBay also had a very similar message. They said the job cuts are necessary to create long-term sustainable growth. It's this idea of sustainability and maybe not being able to sustain the growth rate at which these companies were on now that the environment has softened. And we know they are not the only two companies experiencing this. We can see tech layoffs picking up. That's the white bars here on this chart relative to the other job cuts tracked by Challenger Grain Christmas. So you can see that this is really something that is happening. And it is reflected, too, as well in the economic data. Yes, we had a blowout jobs report last week, 570,000 on the headline figure. But information sector jobs actually were down 5,000 as they were in December. So it's starting to show up, John. And the question is, will it start showing up in a bigger way, considering many of these cuts are just announced? They haven't actually happened yet.
Good
so
point.
We may see a bigger translation into the data later on.
Hey, Katie, thanks for that. Let me just repeat that line. Zoom's cutting the headcount by 15% after tripling it in just 2 years. Goldman put out some research a little bit earlier this week. Sam Rowe, out on Twitter, tweeted this out. It's a fantastic chart. Here's the quote. Roughly 15% of companies in the S&P 500 have seen headcount increases of 40% or more. So that's 15% of companies in the S&P have seen headcount increase 40% or more since the start of the pandemic, and only 1/5 of them have announced layoffs so far. Rob Walder, can I come to you on that? When we think about excess, how much excess is there hanging over from the pandemic period, and how much of it needs to be unwound?
We think we've made it through most of the excess that we had in the pandemic. Certainly, if you look at the consumer side, there is some evidence there might still be some excess savings, but it's probably not in pockets that are easily tapped. So we think the pandemic, those elements are kind of behind us. What's supportive probably going forward that's picking up from that I think maybe we didn't really anticipate is that as inflation slows, just real disposable income is picking up. So as inflation slows, as gas prices come down, we're getting another little leg here for people to pick up some disposable income, which is, I think, the good news, one of the pieces of good news for the economy here.
Back in the pandemic, we talked about the casino on Wall Street. That's getting more conversation again. Julian, in fact, you wrote about it this morning. I want to share some of your work with our audience. I talked about it a little bit earlier on. You said this: we had a 1.5 to 2% bear, bull, bull sequence yesterday. Bull, bear, bull sequence, to be precise. You said why? Because zero-day to expiry options trading has become an important marginal price setter. You said look at options volumes yesterday, dominated by zero, and one-day to expiry SPY options, and higher rates have caused this unintended consequence. As people have moved out of 0% money market funds and deposited at places where they can get 4% interest and take 10% of their capital and trade options. Julian, build on this. What's happening here?
So again, when you do what you've done to monetary policy as quickly as the Fed has done it over the course of the year, there are all sorts of unintended consequences. And who would have ever thought that in a little slice of the market that actually raising rates would cause more speculation, simply because you still have a situation where that your average bank in your average money market fund is still paying below market rates because it doesn't need the deposits. So that money is moving. And frankly, when you're in an environment that is as confusing at the macro level as it is right now, and yet people still have savings and still have investing interest that they've built up almost from scratch, if you go back to 2019, it's really just a natural outcropping of what can happen. And obviously the leverage inherent in those kinds of options can be very attractive when you win once, twice, or three times, despite the most likely outcome in a range trading market being less successful.
Julian, let's go one step further. Is this the tail wagging the dog all over again? The reason I ask is because when we see big moves like the one we've seen year to date, particularly on the NASDAQ and on the S&P 500, we might try and assign some kind of fundamental narrative to a price move, just a story. We like telling stories. How much of what we've seen, Julian, is down to what you've just described?
There's certainly a large element. Is it the undue element? No, because I would say that part of what we saw at year end, albeit somewhat options driven, was really, extreme tax loss selling to where the stocks that were underperformers at the end of the last year literally had no place to go except up. Now, would we have expected those names to move 60, 80, 100% in a month? Absolutely not. Have options exaggerated that move? Definitely.
The move's been huge, that's for sure. Julian, you're going to stick with us alongside Rob Waldner. Your equity market down 0.4% on the S&P. Coming up, we'll head to D.C. President Biden ditching the script.
Some Republicans want Medicare and Social Security to sunset. I'm not saying it's a majority.
That conversation up next.
Instead of making the wealthy pay their fair share, some Republicans want Medicare and Social Security to sunset. I'm not saying it's a majority. Let me give you, anybody who doubts it, contact my office. I'll give you a copy. I'll give you a copy of the proposal. That means Congress doesn't vote. Well, I'm glad to see you. No, I tell you, I enjoy conversion.
Chaos gripping Capitol Hill, the State of the Union filled with partisan jabs. President Biden sparring with House Republicans before turning his attention to China.
But in the past 2 years, democracies have become stronger, not weaker. Autocracy has grown weaker, not stronger. Name me a world leader who changed places with Xi Jinping. Name me one. Name me one.
Let's get to AMH down in D.C. Morning, Anne-Marie.
Good morning, John. That was an interesting moment because it wasn't prepared in the remarks that we got for the release. This is Biden off script and really going right after directly naming Xi Jinping. Obviously, going into the State of the Union, of course, the surveillance balloon incident was something that was going to overshadow this. He didn't directly talk about it, but he did make reference to it. But we should say the president also took a little bit more of a reasonable tone when it came to China, in the sense that he said that they want to make sure they can continue to work with China on things that make sense for both Beijing and Washington. You think of things like climate change and those kinds of talks, but also that they want to make sure that they are setting up the United States to vigorously compete with China. But on the domestic front, Jonathan, of course, the viral moment was when the president spoke about the debt ceiling. And he talked about the fact that some Republicans want to sunset Social Security and Medicare. Take a listen.
Let's commit here tonight to the full faith and credit of the United States of America will never, ever be questioned. We're not going to be moved into being threatened to default on the debt if we don't respond. As we all apparently agree, Social Security and Medicare is off the books now, right? They're not to be responded. All right. I'm ready. We got unanimity.
So, Jonathan, that is the moment this White House wants to really relish in. The president was looking at someone who the American people are for, in the sense that they don't want to see, by and large, Social Security and Medicare going away. But then you had the likes of some of these rebel rousers in Congress, like Marjorie Taylor Greene, getting up, pointing the finger at the president and calling him a liar.
I'm not sure that was the viral moment, but we'll leave that there. AMH, we'll talk about that one a little bit later. Can I pick up on this, just pushing forward? We heard from the Vice President earlier on this morning on CBS. She said if Biden runs, I'll be running with him. When are we getting the announcement?
It's a great question. So the State of the Union is behind him. He's still dealing, obviously, with the documents probe. There's a special counsel that's been appointed for that. And I think this administration would like to put that behind them before they made this announcement. But they're preparing for it. It's coming April or March. And this was part of, the 2024, looking into 2024, this speech could be seen as a soft launch. Now, the argument to that is obviously the president doesn't want to be a lame duck president. So I think likely a lot of the same the mission he wanted out of this speech would have been the same whether or not he was running or not. But definitely there were moments there. The real focus on the domestic agenda was something that really paints the picture for him in running in 2024. And we've already heard it from Ron Klain 2 or 3 times. It's not if, but when the president announces.
Anne-Marie, thank you. And again, happy birthday. Birthday love from the Open team to AMH. Anne-Marie, thank you. Back with us, Julian Emmanuel, Rob Waldner. Let's continue the conversation. We can do the domestic stuff, then we'll get international. Rob, let's start domestic. It's that time of the morning. I usually reserve about 60 seconds for this conversation. It's about how long it lasts. I mention the debt ceiling, someone shrugs, and then we move on. Rob, is that how you talk about the debt ceiling debate?
Well, the debt ceiling debate is still pretty far out there, right? So it's medium-term risk, which is very hard to price into markets. But, when you game this out, Jonathan, it seems like it's probably going to be messy. So that is one of the factors that, I think as investors, as we get out to the ends of the first quarter, beginning of the second quarter, we're going to have to pay attention to. My career has been long enough where I remember the vote on TARP. And, sometimes the market has to force Congress's hand. And I hope that doesn't happen this time. But I think it's a risk. There's a fear we get a repeat. On the horizon, that's the issue, Julian. In the here and now, there's this tension again between China and the United States, tension that hasn't really gone anywhere against the backdrop of a rip-roaring rally for some of these names. Listed here in the United States as well, the ADRs, the China names are just absolutely ripped. Your thoughts, Julian, on what you're focused on right now? Is it the domestic debt ceiling issue, or is it the international relationship with China?
Well, it's certainly both. And obviously, they are going to be, as the year unfolds, of greater and lesser importance in terms of the headline risk. Just quickly on China, as you know, John, we've been behind the rally essentially since the aftermath of the party Congress. Those stocks, those ADRs have moved a very long way. Nothing goes in a straight line forever. We think long-term the reopening is very, very supportive, but you're likely at a pause here. Now, in terms of the domestic situation, it's very important to remember that one-year credit default swaps on U.S. sovereign debt are already bumping up against the extreme pricing that we saw at the first debt ceiling in 2011. So while we don't think that the U.S. defaults on its debt, we do think that the risk is it's going to feel that way, perhaps at a time when money supply is contracting further, leading economic indicators continue to point down, and the employment market probably starts to weaken at mid-year. All of those conspired could cause the downturn that we expect to happen eventually to happen sooner and perhaps be greater. It's definitely a risk.
The fact that CDS is even trading, I think, is a story in and of itself, Julian, and we can talk about it another time. You mentioned the Chinese names. Baidu, let's put some numbers on a long way. That phrase, a long way, here's a number for you. Baidu's up more than 100% from the end of October. Julian, I'll put another number on things. You guys have got China GDP at 6%. Lots of people started the year saying, Julian, I want to play the reopening story. And we were saying a few weeks into 23, Julian, have we seen the reopening story play out already?
No, look at the energy market the last several days. There is a bid there, despite signs of weakening in the economy elsewhere, albeit small. But the fact is that when you think about the fullness of that story and the idea that the virus itself has really worked its way through the majority of the population in China, the reopening story is very much alive. And likely we've only seen the opening innings of it.
Julian, great to catch up to get your thoughts on a range of issues. Rob Waldner to you as well. Rob, Julian, thank you as always. We are about 7 or 8 minutes away from the opening bell. Equities down just a little bit by 0.5%. Big rally off the back of Chairman Powell's comments or non-comments yesterday. Yields come in just a little bit by a couple of basis points on a 2-year, on a 10-year. The 10-year down to about 366 on a 10-year this morning. Coming up, the morning calls, and later, a decade of free money coming to an end, putting multinationals on notice. That's the view from Bank of America's Jill Carey-Hall. She joins us at the opening bell. That's coming up shortly. 5 minutes away from the opening bell. Equity futures retreating just a little bit, down 0.5% on the S&P. On the Nasdaq, down 0.4%. Yesterday, decent day of gains, snapping a 2-day losing streak. Let's see what this looks like by the end of the day. That's the price action. Here's some morning calls for you. First up, Morgan Stanley upgrading American Express to overweight, naming the stock its top pick in consumer finance, given its sustainable revenue growth. That stock up by 1%. Bank of America upgrading TripAdvisor to buy from underperform, raising the stock by 2 notches as management continues focusing on margins. We advance there, rally 7%. And finally, KeyBank downgrading Sherwin-Williams to sector weight, expecting weaker demand to limit the company's valuation. That stock is negative by 1.9%. Coming up, Bank of America's Jill Carey-Hall seeing a challenging backdrop for multinationals this year. Why safe sectors are becoming risky in 2023. That conversation just around the corner. 23 seconds away from the opening bell this morning. Good morning to you. Equity futures negative 0.5% on the S&P. On the Nasdaq, down 0.5%. Also a rally, a lift off the back of Chairman Powell's comments yesterday. Just retreating just a little bit right now as we get some comments from the New York Fed President John Williams. I'll get to those comments right now. There's your opening bell. Switch at the board and look at the bond market. Yields look like this. They're coming about a basis point on the US 10-year. John Williams speaking at a Wall Street Journal event right now and saying the following. 25 basis point increases seem like the right size. If the situation changes, we can move faster than 25 basis points. A peak rate of 5% to 5.25, still a reasonable view. There is a lot of uncertainty around the inflation outlook. We'll pick up on those comments in just a moment. Euro dollar, the big range of the last week from 110 down to 106 and right now 107.31. We're going absolutely nowhere. On crude at 1% to about $78.13. 30 seconds into the session, we retreat by 0.4% on the S&P. On the Nasdaq, we're down about 0.4%. Also, the sector to watch at the open, it's tech. eBay and Zoom becoming the latest tech firms to slash their workforce. eBay blaming its 4% cut on economic forecasts. The CEO saying they are necessary to, quote, create long-term sustainable growth. Abby has more. Hey, Abby.
Hey, John. Well, this story goes on. We've had so many tech companies laying people off recently, and there seems to be two main reasons. One, it has to do with overhiring in the pandemic, or two, more what eBay is talking about, tougher trends. So in the former category, think of Salesforce.com, Microsoft, Alphabet, Amazon, and so on. In the latter, think about Dell, where they're talking about those difficult trends. So eBay has seen their sales decline, so they are having a more difficult fundamental background. So they're dealing with it with these job cuts. They are cutting they're cutting a number of people, 4% of their global workforce, or about 500 people. This as sales started declining in the first quarter of last year, down 6%. For this current quarter we're in, down 5%. So clearly they want to see that change. It's interesting, though, because you would think that the workforce reductions would target more the margin situation, but nonetheless, that's one strategy that they are taking. Now, relative to Zoom, it seems to be a little bit of both. They're cutting 1,300 jobs, or about 15% of their workforce, returning to 2021 levels, as you and Kaylee have been talking about. It's just extraordinary. They tripled their workforce to 8,400 people between 2019 and October of last year. Now they're paring it back, but they're also seeing a reduction of use coming out of the pandemic. What's so interesting about the stock, though, John, is it's down 86% from the pandemic boom, but it's still more than a double from the IPO. So I'm guessing that they are trying to preserve some of that stock growth for sure.
Abby, thank you. Those comments keep coming through from the New York Fed President John Williams, who says he broadly sees financial conditions as being tightening a lot in the past year. Now, this, of course, depends on what time period you look at and what you look at to establish what financial conditions are doing. Now, if you just take markets over the last few months, let's go year to date on the NASDAQ, up 16%. Take the dollar, which peaked at the end of September, negative about 10%. Look at credit spreads from the wide to last year. High yield, tightened by 200 basis points. Have they tightened a lot over the last 3-4 months? That would be the pushback, but their time period seems to be over the last year. Bit of confusion around this. Mike McKee going to talk about it in about 15 minutes. I'm looking forward to that conversation. Just to return to the price action of the moment, about 3 minutes in, we're negative 0.5% on the S&P. On the NASDAQ, we're down 0.6%. Yields basically unchanged now at the front end. The 2-year 4.46, on a 10-year 3.67. I want to stick with tech. Microsoft rallying for a second day after unveiling its new AI software, a search engine using ChatGPT to compete with the likes of Google and Baidu. The CEO, Satya Nadella, said this technology is going to reshape pretty much every software category. Kelly Lyons has more. Hey, Kaylee.
Hey, John, it's the new frontier, the new big thing, and it seems we can't go a day without talking about AI and investors getting excited about AI, which arguably is why Microsoft is positive on the day, even though we did get some arguably bad regulatory news out of the UK with the CMA taking issue with their $69 billion deal to buy Activision because they say it'll harm competition in the UK gaming market. That's why Activision is lower by about 2.4%. But back to the AI thing, this is really about making Bing and Edge more competitive. And I know some of you out there are asking, is Bing even still a thing? It has really struggled to gain traction against competitors like Google. But that is what these new products with the ChatGPT software and the billions of dollars in investment into OpenAI are trying to accomplish. The new Bing can be switched in and out of chat mode. The new Edge browser adds the AI-based Bing for chat and writing text. It can summarize web pages, respond conversationally to queries, and investors and analysts, the sell side today, seem to be into it. So that is what is adding to the gains Microsoft has already seen this year. It's already seen more than $200 billion in market value added. And this is part of a broader big tech rally we have seen in 2023. When you add it all up among those 6 large stocks we have here, $1.4 trillion worth of value gained in just over a month period, even though earnings arguably haven't been that great. And of course, for NVIDIA there, which has had about $185 billion added in value, that is also an AI play, John. A lot of it comes back to this.
Kelly, thank you. Here's the line from Williams. If financial conditions loosen, more higher rates may be needed. Fairly intuitive, but certainly not what we heard much from Chairman Powell over the last week or so. Again, Mike McKee's going to drop by the studio and we'll talk about this. So you Google, you don't Bing, and you Uber, you don't Lyft. Uber this morning beating analyst estimates with ridership and driver base hitting an all-time high. We ended 22 with our strongest quarter ever, with robust demand and record margins. The pandemic's impact on our mobility business is now well and truly behind us. Mandeep Singh, this stock is flying.
Look, I think when you look at the print, obviously there's a lot to like here, but the most notable thing for me is they're able to grow supply in the marketplace by about 35%. Now, what that tells me is not only is inflation a tailwind for their business on the pricing side, but it's also helping them on the supply side, because remember, a lot of people are looking to supplement their income, and Uber seems to be that place where they can do that. And that's why I feel like with any marketplace, if you see supply growing in line with top line, that's a very healthy sign. And also they've improved their execution in terms of cutting costs, the incremental margins are going up. And finally, you're seeing some synergies between their ride sharing and delivery, which is their Uber One subscription. So a lot to like in that print. The one more thing I would call out is their ad business. They said it's a $500 million run rate. Now, that is, even though it's a side thing for a company of Uber size, over $30 billion in revenue, but still it's a very high margin business. So I think that's why you see that, optimism around this
Mandeep, at times we used to talk about streaming and say there could only be one winner. Who would it be? Maybe it would be Netflix. In this space, when you see the success of Uber in this quarter, is it at the expense of Lyft?
To an extent, I would say it will come at the expense of the smaller players, and not just Lyft. I mean, this market is so fragmented. For the last 2-3 years, you had got a lot of niche players. And look, there are certain players that have carved out, scale. For example, Instacart on the grocery delivery side, but DoorDash on the food delivery side. But still, I feel like Uber with its scale and on the supply side, I think that's going to be a big advantage and something to watch out for. I mean, one data point doesn't make a trend, but clearly they seem to be executing very well on the supply front.
I'm just looking at the year-to-date performance, and Mandeep Singh, thank you, sir, from Bloomberg Intelligence. Uber's up almost 50% year-to-date. DoorDash up 31%. Lyft is up 63%. Year-to-date, these names have been flying. For the broader market, 7 or 8 minutes into the session, equities are lower by 1/3 of 1%, just about off the lows. Early days on the Nasdaq down by 0.4 of 1%. Bank of America's Jill Carey-Hall sounded the alarm on big US multinationals, writing the following: cyclical and secular challenges face the sector, this is tech, amid the reversal in 10 years of free money, a pause in globalization, and a massive COVID demand pull forward. Jill, I'm pleased to say, joins us right now. So, Jill, you guys have written about this, so talk to me about it. The globalization beneficiaries of the last decade or so, do you think there needs to be some kind of valuation for multinationals to de-rate?
Well, I think you've seen, as you said, many decades where S&P 500 companies' margins have expanded on a secular basis, and globalization was a really big driver of that. Lower costs from offshoring, lower labor costs, lower taxes overseas, and we were in a backdrop where tech and growth stocks were the leadership, and we think that in the next cycle we could see some new leadership. Many of these stocks benefited from free money, zero interest rate policy. They saw that secular expansion in their margins. And even after the recent layoffs, we're still seeing that, labor is still bloated relative to sales growth at many of these companies. So, earnings have missed for tech this quarter. We've seen NASDAQ earnings come down relative to S&P 500 earnings, where after, many decades, the opposite was true. So, we see challenges for tech going forward. It is a cyclical sector. We saw a lot of demand pull forward during COVID, but it is a sector that tends to be more cyclical during recessions. And we think if we do go into a recession this year, which our economists are expecting a mild one, this could prove to be a more cyclical sector.
Jill, a couple of points there. Let's pick up on the first one. Earnings have missed, but the stocks have rallied. Jill, can you explain why?
Look, I think there was a big, positioning and sentiment-driven rally this year. We had pointed out late last year that sentiment had gotten very negative on the market for the first half. And as we moved into January, we saw that kind of positioning reversal. If you look at what sectors have done well this year, it's been, kind of the exact reversal of what did well last year. And, many of the sectors that won last year have done poorly this year. So, some of the misses this earnings season have been underperforming. There's obviously also been optimism around, China reopening, potential for soft landing in the U.S. So, we think those have been some of the drivers of the rally in January and year to date.
Can I pick up on that point, Jill? I think it's a really important one. Your point as a team pushing back against maybe the valuations of multinationals. How do you pair that with the thirst, the hunger right now to get exposure to a better international story off the back of China reopening?
Sure. Well, I think, you know, the multinationals will certainly have some tailwinds in terms of the global economic backdrop in China reopening, in terms of, you know, just if the dollar, we see some reversals there. But overall, I think they've benefited from some of these trends that we've been talking about for many decades. And, you know, on China reopening specifically, obviously some areas like materials and commodities have rallied on the China reopening expectations. We think the recovery there will be more consumption-led, so, you know, perhaps some different beneficiaries than the typical China recovery story.
Clearly, the overwhelming feature of some of the research for you guys over the last few months, Jill, has been the margin pressure. Is there a shelter from some of those themes? Where do you find that shelter?
Yeah, so I think so. We're definitely seeing cross currents within the margin backdrop. So, you know, no question we think earnings and margin expectations for the overall market have been too lofty. We do expect earnings estimates to come down further this year, even after the you know, large amount they've been slashed heading into this earnings season. We're looking for a 9% decline in earnings year over year, which is about half of the typical earnings decline you'd see in a recession, given our expectations that if we do see one, it'll be mild. Consensus is still looking for slightly positive growth. But I think there are, you know, a number of companies and sectors within the market that, you know, could see some margin benefits this year. You know, areas like some of the consumer staples or home builders where you're seeing, you know, lumber prices or many of the input costs reverse. So we think this year is definitely going to be less about macro, more about cross currents in the market, and it's going to be a good environment for, you know, picking stocks and sectors, active management.
I want to finish on this line here from you, because I teased it. Risky sectors are safe, safe sectors are risky. Help us all understand that, Jill.
Sure. I think, you know, when you look at sectors like tech, they've actually seen their beta go up, and tech is one of the higher beta sectors. Whereas if you look at some of the sectors that are traditionally riskier, higher beta sectors like financials and energy, they've actually seen their betas decline a lot over the last year and enter some of the now lower beta sectors. So I think, you know, risk profiles of some sectors have changed. You know, we've seen that within small caps as well. You know, small cap healthcare is one of the areas within small caps that I've been relatively more cautious on. Typically, you want to own healthcare in a recession, but healthcare in small caps has deteriorated dramatically in quality. 60% of that sector in small caps is non-earning stocks. So I think there are some shifts we've seen in sectors that, you know, the typical recessionary playbook may not necessarily apply, where, you know, financials looks a lot more like a high quality sector relative to how it looked going into the financial crisis. You know, energy companies have you know, are much more disciplined now. They're morphing into free cash flow generating companies. So we're definitely seeing a lot of shifts in sector risk profiles.
Hey, Jill, I've really enjoyed reading the research, particularly over the last month or so to start the year. Jill Carey-Hill there of Bank of America, alongside Savita Subramanian, putting out some brilliant equity research in the last couple of months. Want to get you a few more headlines. Alphabet, Katie Lyons, you talked about Microsoft. Alphabet getting hammered in early trading.
Yeah, we're down about 5.5% right now, so just off of session lows, but could be the worst day for the stock in some time. And this is about this AI competition and race to introduce these products. We were just talking about Microsoft making the investment into OpenAI. Google is also trying to do this with its own search engine with their AI chatbot Bard. But Reuters is actually reporting this morning that in an online advertisement for Bard, it was delivering inaccurate answers, which maybe is why we are seeing such a down move for the stock right now, considering everyone seems to be rushing to put out this technology. If it is inaccurate technology, obviously that puts you at a competitive disadvantage at a time when Microsoft is ramping this up, Baidu is ramping this up. We're seeing millions and millions of dollars in funding going to various startups in this space. It's a race, John, and right now Alphabet doesn't look like they're out front.
The spread between those two stories, those two names right now, fascinating. Katie, thank you. Microsoft up by 3%, Alphabet down by about 5%. Coming up, Fed speak, picking up following last week's decision.
We're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time.
We'll get you the latest comments from the New York Fed President, John Williams, with Mike McKee up next.
We're just at the beginning of this process. The disinflationary process, the process of getting inflation down, has begun. It has a long way to go. These are the very early stages of disinflation. It's not going to be, we don't think, smooth. It's probably going to be bumpy. This process is likely to take quite a bit of time. My guess is it will take certainly into not just this year, but next year to get down close to 2%. We think that we're going to need to do further rate increases, keep rates at a restrictive level for a period of time. The base case is for me is that it will take some time, and we'll have to do more rate increases, and then we'll have to look around and see whether we've done enough.
Chairman Powell, for the most part, sticking to script yesterday, setting the stage for a busy week of Fed speak. New York Fed President John Williams speaking right now, saying moments ago, we still have work to do. If financial conditions loosen, higher rates may be needed. And going on to say this, Mike, just a moment ago, putting a timeline on a period of time, maintain restrictive stance for a few years. That coming in just moments ago.
Yeah, a restrictive stance, though, might be lower than 5.25%. He did say that he still thinks that a 5.25%, what the Fed thought they would be at when they did their last dot plot in December, is still a reasonable view. And he came back saying, basically, as Jay Powell did, still have our work cut out for us. We are barely into restrictive at this point, and a 25 basis point increase seems like the right size. And then adding, as you just mentioned, that looser financial conditions might imply they have to go higher than 5.25% if inflation remains sticky. And that's the big question is they don't know exactly what's going to happen. And Williams basically saying we're data dependent. We're going to follow what the data are telling us. And that might mean we go higher. That might mean we stop at 5.25%. But he did suggest it's going to stay there for a while, which is the base case message from the Fed. And it seems like the markets are finally listening. When you look at the yield curve over the last week, from last Wednesday, that's the line on the bottom, to today, the white line, you can see that markets have priced in higher rate level all across the curve. And
Yep.
It does appear that maybe they got the message. You did mention there's a lot of Fed speak out there today. Barr, Bostic, Kashkari, and Waller yet to come.
Can't wait.
And we have Lisa Cook speaking now, although nothing's hit the wire from her yet. So I guess basically we could have simplified this and just handed out a piece of paper to all of them that come out and say, yeah, what he said, that Powell guy.
What she said, what he said, and what they all said. Mike, I want to finish on this. There's been some pushback around financial conditions. All of this depends on how you measure financial conditions and over what time period. John Williams, moments ago, said financial conditions broadly have tightened a lot in a past year. Mike, the chairman took some criticism on Wednesday when he made similar comments in the news conference. Where are you on this debate?
Well, as you say, it depends on the time horizon. If you look at financial conditions from the time the Fed started raising rates in March of 2022, then yes, they've tightened significantly. Over the past 3 or 4 months, they have come down. It just depends on whether you think financial conditions are slowing the economy enough, slowing inflation enough. And at this point, the Fed isn't sure. Even though they've come down, we have seen inflation come down. So they're going to keep an eye on this. And of course, next Wednesday, we've got the CPI.
Mike, there's a feeling they don't care about the equity market in maybe the same way they did in the summer. Would that be the correct read?
Or for the last couple of years, yeah. It's like mom used to like me, but she doesn't anymore. The Fed is.
Are you talking about equity market bears being
the
looking
Fed
up to Chairman Powell's
credibility
mom?
question, and they say they need to keep rates high long enough to keep the inflation rate going down. It's been a long time since they had to do that, and people on Wall Street weren't around then, and so now it's going to be a test of wills. Who can go longer, the Fed or the markets, hoping for a Fed put?
Mike, thank you. As always, appreciate it. About 22 minutes into the session, we're lower by 0.5% on the S&P and the Nasdaq down by 0.6%. Just to lift the lid on the index and break it down sector to sector is Abby.
John, very interesting sector action today, only because of the decline that we're seeing right now, relatively modest, yet most sectors for the S&P 500 lower, some of them significantly. Communication services in particular down 3.2% on that Alphabet fall that you and Kelly were talking about on the AI competition. We also have utilities, consumer discretionary, staples and industrials down there. So lots of defense down. On the year, though, take a look at these travel sectors, airlines, hotels, railroads, and there's Uber, as you were talking about, up 44% this year.
Abby, thank you. That's your sector price action. The broader index down 0.4% on the S&P. Your trading diary up next. Close to 26 minutes into the session, equities taking a little bite out of a big year-to-date gain on the S&P and on the Nasdaq too. Equities right now down about 0.5% on the S&P, still up on the year by about 8%. On the Nasdaq, close to 16 percentage points higher, lower on the session by 0.8%. That's the price action. Here's the trading diary. Coming up, Fed speak, Barr, Bostic, Kashgari, Waller, all on deck. Cook talking right now. President Biden discussing the US economy at 2 p.m. Eastern time. We get earnings after the bell from Disney, another round of jobless claims tomorrow morning, and we end the week with a UMich sentiment survey to close out Friday and get straight into the weekend. Live from New York, that is it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.